There's a signal hidden in the banking system that most people have never heard of. It doesn't make headlines. It doesn't trend on social media. But for 95 years, this signal has predicted every major financial collapse with mathematical precision. In 1929, it flashed red, 47 days before Black Tuesday. In 1987, it triggered 47 days before Black Monday. In 2008, it activated 47 days before Lehman Brothers collapsed. 3 weeks ago, that same signal just flashed red again. The people who understand this signal call it the Repo Reversal Indicator. The people who profit from it simply call it the 47-day clock. Once it starts ticking, you have 47 days to prepare for what's coming. Most people won't. Most people will spend those 47 days believing everything is fine, that markets are resilient, that the system is stronger now. That's what people believed in October 1929. That's what people believed in September 2008.
To understand why this signal exists, you have to understand how banks actually work. Not the version they teach in economics classes, the real version. Banks don't hold your money in a vault. They lend it out. When you deposit $1, the bank loans 90 cents to someone else. That person deposits their 90 cents in another bank. That bank loans out 81 cents. The process continues until your original dollar has created nearly $10 of loans throughout the system. This is fractional reserve banking. It works when everyone trusts everyone else. When trust breaks, the entire system implodes.
The Repo Reversal Indicator measures when trust begins to crack. Repo markets are where banks lend money to each other overnight. It's the circulatory system of the financial world. When banks trust each other, they lend freely at low rates. When doubt creeps in, they either demand higher rates or stop lending altogether. The signal tracks a specific pattern. When overnight repo rates spike above a critical threshold and stay there for 7 consecutive trading days, it triggers the 47-day countdown. This isn't theory. This is documented fact. Let me walk you through how it happened each time.
In August 1929, banks were riding high. The stock market had tripled in 5 years. Everyone from taxi drivers to professors was buying stocks on margin. The newspapers called it the new era. Prosperity had become permanent, they said. Sound familiar? But underneath, cracks were forming. Small regional banks had been failing all summer. Agricultural debt was mounting. The Federal Reserve had been tightening monetary policy. On August 9, 1929, overnight repo rates spiked from 5% to 9% in a single session. They stayed elevated for 7 trading days. The Repo Reversal Indicator had triggered. Financial insiders knew what this meant. J.P. Morgan quietly began liquidating positions. The Rockefellers started moving money into gold and real estate. Bernard Baruch was almost entirely in cash by September. But the general public kept buying stocks. The newspapers kept reporting record highs. The party continued for 47 more days. On October 24, 1929, Black Thursday arrived. By October 29th, Black Tuesday, the market had lost 25% of its value in 5 days. Banks that seemed invincible were suddenly insolvent. The Great Depression had begun. The 47-day signal had performed as designed. 58 years later, it happened again. In July 1987, the American economy appeared unstoppable. The Cold War was winding down. Technology was booming. The stock market had gained 44% in 7 months. Fed Chairman Alan Greenspan was being hailed as an economic wizard, but the same stresses were building. The federal deficit was exploding. The dollar was weakening. The Federal Reserve had been aggressively raising rates. On July 28, 1987, overnight repo rates jumped from 6.5% to 12%. as banks became suddenly reluctant to lend to each other. They remained elevated for 7 trading days. The signal had triggered again. Smart money began moving to the exits. Warren Buffett famously said the market was priced for perfection and quietly reduced positions. Corporate insiders accelerated stock sales. But retail investors kept pouring money into mutual funds. The media kept celebrating new highs. 47 days after the repo signal triggered, on October 19, 1987, the market collapsed. The Dow Jones fell 22% in a single day, the largest single-day percentage decline in its history. Black Monday had arrived precisely on schedule. 21 years later, the pattern repeated with terrifying accuracy. In summer 2007, housing prices were still rising. Banks were still profitable. The subprime crisis was being dismissed as contained. Fed Chairman Ben Bernanke assured Congress that housing problems would not spread to the broader economy. But credit markets were beginning to seize. Small regional banks were failing. The Federal Reserve had spent 2 years raising rates from 1% to 5.25%. On July 30, 2007, overnight repo rates exploded from 5.25% to 11%, as banks suddenly refused to accept mortgage-backed securities as collateral. The 7-day trigger pattern completed on August 8th. The countdown had begun. Hedge funds that understood the signal began shorting financial stocks and buying credit default swaps. Goldman Sachs famously began betting against the same mortgage securities they were selling to clients. But the general public remained optimistic. Home prices kept rising. Bank stocks continued reaching new highs. On September 15, 2008, 47 days after the signal triggered, Lehman Brothers collapsed. The global financial system nearly imploded. The Great Recession had begun. Once again, the 47-day banking signal had performed with mathematical precision. Now look at what happened 3 weeks ago. On the surface, everything appears stable. Stock markets are near all-time highs. Unemployment is low. Corporate profits are strong. The Federal Reserve has been declaring victory over inflation. But underneath, the same stresses that preceded every previous crash are building to dangerous levels. The federal deficit has exploded to over $2 trillion annually. National debt has crossed $34 trillion and is growing by $1 trillion every few months. Regional banks are sitting on hundreds of billions in unrealized losses from their bond portfolios. Commercial real estate values are collapsing as office buildings sit empty. The Federal Reserve has raised rates at the fastest pace in 40 years, from 0 to over 5% in less than 2 years. 3 weeks ago, on a Tuesday that most people ignored, overnight repo rates spiked from 5.35% to 11.2% in a matter of hours. Banks had suddenly become reluctant to lend to each other, especially when the collateral involved commercial real estate or long-term government bonds. By the end of that week, the 7-day trigger pattern was complete. The Repo Reversal Indicator had activated for the 4th time in 95 years. What makes this signal so reliable? It measures when the banking system's confidence in itself begins to crack. Banks are the most conservative institutions in the economy. They employ armies of risk managers and economists. They have access to data that regular people never see. When banks stop trusting each other, it's because they know something that isn't public yet. The 47-day timeline exists because that's how long it takes for loss of confidence to spread through the interconnected global financial system. Day 1 through 14. Only the most sophisticated institutions recognize the danger and begin repositioning. Day 15 through 30, the stress begins showing up in bond markets and credit spreads. Day 31 through 47, the cracks become visible to everyone, but by then, it's too late to exit safely. This time might be different in one crucial way. It might happen faster. In 1929, information traveled at the speed of telegraph. In 1987, it moved at the speed of telephone. In 2008, it moved at the speed of email. Today, information moves at the speed of algorithm. High-frequency trading systems can execute millions of trades per second. When the selling begins, it could cascade through global markets in hours rather than days.
Foreign central banks have been quietly reducing their holdings of U.S. Treasury bonds for months. The Japanese yen has been strengthening rapidly as investors unwind the carry trade. Gold has been reaching new highs despite rising interest rates, suggesting smart money is moving toward hard assets. Corporate insider selling has reached levels not seen since 2007. CEOs and CFOs are dumping their own company stock at a pace that suggests they know something their shareholders don't. Meanwhile, retail investors continue pouring money into index funds and ETFs. Retirement accounts continue buying the market regardless of price. The same pattern from 1929, 1987, and 2008 is playing out again. Smart money exits quietly, while regular people provide liquidity for their escape. What happens when day 47 arrives?
History suggests the crisis will begin somewhere unexpected. In 1929, it started with a British financial scandal that forced European banks to sell American investments. In 1987, it began with fears about the federal deficit and rising bond yields. In 2008, it started with a small investment bank that nobody thought was systemically important. This time, the trigger could be geopolitical. A miscalculation in Ukraine or Taiwan that sends energy prices spiking. It could be financial. A major hedge fund blowing up, a sovereign debt crisis in Europe, a derivatives accident. It could be technological. A cyber attack that disrupts payment systems. Or it could be simpler. A major corporation defaulting on bonds. A regional bank failing from commercial real estate losses. A pension fund forced to liquidate assets.
The trigger doesn't matter. The system is already primed for collapse. The debt levels, the leverage, the interconnectedness, the loss of trust between institutions. All the ingredients are present. The trigger will simply determine the timing. What makes this particularly dangerous is that most people believe the system is stronger now than it was in 2008. New regulations, they say. Better capitalization. Improved risk management. More oversight. But the same things were said before every previous crash. Regulations always fight the last war. They prepare for the crisis that just happened, not the crisis that's coming next.
The current financial system is actually more fragile than it was in 2008. The derivatives market has grown to over $600 trillion in notional value. A single counterparty failure could cascade through the entire global system. Passive investing has concentrated stock ownership in a handful of index funds, creating artificial correlation that amplifies both bubbles and crashes. The Federal Reserve's balance sheet is still bloated with over $7 trillion in assets, giving them less room to respond to the next crisis. Most importantly, the social contract between governments and citizens has weakened. In 2008, bailouts were unpopular but accepted as necessary. Next time, the political system might not be able to respond quickly enough. The trust that holds democratic societies together has eroded. When the financial crisis arrives, it might trigger a broader crisis of legitimacy.
The Repo Reversal Indicator doesn't predict the future. It reveals the present. It shows that the banking system has lost confidence in itself, even if that loss of confidence hasn't become visible to the general public yet. Once that process begins, history suggests it's irreversible. The only question is how the final 47 days play out. Some people will use this time to prepare. They will reduce exposure to overvalued assets. They will build emergency funds. They will position themselves to survive and thrive during the reset that follows every major crash.
Others will spend these 47 days believing this time is different, that the signal is wrong, that the system is too big to fail. History suggests which group will be right. The signal has been activated. The countdown has begun. What happens next will determine whether you become a victim of the coming crisis or one of the few who saw it coming and prepared. The choice, as always, is yours. But the clock is ticking.